I work in our executive suite of services, which is our long-term and short-term price outlook service, and as well as some of our macro offerings. Basically, I work with Shu, Trey, George, pretty much pulling together all the analytical numbers they're seeing in terms of supply and demand and these investment levels, and what does that mean for price. And it's a virtuous cycle, obviously, because I also tell them, well, that price is or isn't really realistic, so what does that do to your overall outlook? Just to give you an idea of where I'm positioned within the broader work that we do. So today I'm going to walk you through basically our view for global oil markets in the long and short term, some of our price expectations, and what we see is both the upside and downside risks to these views. Because it's not all bad news. There are, in fact, some pretty substantial upside risks that could help us, especially in the short term. So the big question I'm always getting, are we balanced? Are we there yet? And this is especially important heading into the June meeting, because it's not so much what are we fundamentally at in terms of the barrels in storage for balance going into OPEC. It's what do markets think we're at? What do the traders and the speculators perceive market balance to be? And that dictates how positively or negatively they're going to respond to whatever deal OPEC comes up with in June. So, are they balanced? Clearly there are signs of improvement. We've flipped from contango into backwardation in basically all major grades. I have Brent up here, but it's a similar story in WTI and others. You can see the difference a year makes. It's a pretty substantial improvement. Stocks look great. They've been drawing steadily. These are crude and product stocks, OECD, which is OPEC's assumed metric. They're also, though, non-OECD stocks have been drawing fairly steadily. They've been drawing down. They're approaching the current 5-year average, so the 2017 to 2013 average. It does look like we're basically there. OPEC's done. Here's the problem. Those stock levels are inflated, and this is something OPEC has actually been saying both privately and somewhat publicly since they signed the deal in 2016. We're going to aim for the 5-year average, but we're not positive it's the best metric. And literally last week we had reports, and I speak to people who are working in the Secretariat, and the technical meeting occurred, and while they didn't explicitly come out and say, the technical committee didn't come out and say, we have to change our metric, they did say perhaps the current 5-year average is not the best metric, and that's about as explicit as OPEC gets on these things. Here we are against what the 5-year stock level average was in 2015. Products, the tan line, great. They've been steadily drawing. We're continuing to see declines. Crude, we're still pretty oversupplied. And more concerningly, in the last 4 months of available data, the draws have not been as big. The improvements haven't been as good. So there's still clearly work to be done. Now, we calculate these OECD stocks, and by our calculations, we actually won't be in line with this 5-year average until the start of 2019. Conveniently, we expect the OPEC deal to last until the start of 2019. And these are fairly publicly available numbers. They are doing this exact same calculus right now. So given that there's still work to be done, but we do have these price improvements, we do have these sentiment-driven bull runs occurring, what are we actually seeing for the next 8 quarters and beyond? So let me let you know how we approach this, just to give you an idea. We basically use a scenario framework. So we come up with 4 potential scenarios, bull to bear, and then say, what do we think are the most likely elements of each of those? And that creates our 5th reference case. And as John mentioned, we often take these 4 scenarios and rerun them throughout the year for clients, stress testing different assumptions. We'll have clients who want to see different legislation added in or different price levels, some sort of large outage that we don't think is likely, but they do. So we run these throughout. But our current reference case scenario is that the OPEC deal lasts until the start of 2019, with some cheating increasing in the latter half of the year. So we are going to see slippage in compliance. We've got U.S. unconventional production growing about 1 million barrels a day this year, 800 next. I'll show you where some of that's coming from. And our demand assumptions, fairly conservative. Our reference is about 1.5. Even our bear case is not that much lower, around 1.1. It's a much narrower range. It's clearly a supply story for the next 8 quarters. Longer term, there is a little more fluctuation and a little more question on the demand side of things. really the pace of electrification, the pace of these fuel standards, CAFE and efficiency standards, they're going to be doing a lot more to drive the long-term story than they are the short-term story. And so this, one of my favorite charts actually, here's our possible range of demand and supply cases, as it were. And you can see the demand range that we think is feasible is a little smaller. And actually the bottom of the demand range takes into account an economic slowdown in the OECD nations, because if we had to pick where the next black swan event's happening, we're gonna say an OECD slowdown that mostly impacts the Western countries. It's not that large of an impact on demand because those are already maturing markets. The supply side, however, has a lot of different outcomes, and we tend to hew to the more conservative side of global production, but you can see all the brown up above that red line is basically translated into possible price drops, because that could be supply that comes back to market that we're not currently expecting. So obviously a supply story for now. So here's our Brent price outlook, just to get to the meat of things. Our reference case for this year is about $65, increasing to 66. But wait, we're at 70, we're above 70. How can this be? We are expecting a price correction sometime this year as markets come to consensus that it's gotten a little too overheated the start of this year. And we saw this happen in March as well. It's not going to be a $20 price correction, more like $4 to $5, but we definitely don't see the current sentiment-driven bull run as being all that sustainable, especially because a lot of it came from some geopolitical risks that might have been overblown. But interestingly, you see the gray, orange, and red line, those are possible bear case scenarios. We've got one world in which prices are above ours and three worlds in which prices are below ours. And again, this mostly comes from surprises on the supply side. And then it's a similar story in WTI. The difference being, while Brent is also driven by some demand issues in geopolitics, WTI is primarily driven by the outlook on U.S. supply and market reactions to U.S. supply. So our reference, again, about $60, increasing to 61. We don't really see any Brent WTI differential issues. Over both the long and short term, really, a lot of the bottlenecks in transit that created that initial blowout have been solved, primarily through U.S. can now allow exports. So that gave them the release valve they really needed. And then on the meat of the transportation, the pipeline capacity, they've done a substantial build out since the initial blowout. And we do still have rail car capacity. Rail car utilization is a lot lower than it was. So that exists as another fallback, which is why our Brent WTI cases follow each other fairly closely in terms of the pattern. So longer term, and you saw this once already with John's presentation, this is our reference case. We actually run these numbers all the way out till 2040. For the sake of today, I kept it slightly shorter. You can see the Brent TI blowout. We're generally constructive longer term. We believe that the price recovery will continue despite all the negative things I'm saying about where stocks are. We do think that longer term, due to the lack of investment now, we're going to run into a bit of a supply issue, a tightening of overall supplies that U.S. alone can't solve. We do need to see investment in offshore deep water. We need to see investment out of these OPEC countries once they roll back their current restrictions. So we are generally constructive on pricing moving forward. And then to your question earlier, our light-heavy differential outlook. So this is just a smattering of, we forecast about 78 different crudes on a quarterly basis. We update every quarter. We can do more as needed. We've certainly dealt with special requests before. And then we can pretty much do dips of anything we're forecasting. So quite a few. These are just some of the ones. For the most part, you can see that we have them fairly flat longer term. Regional dislocations will be a problem for some of the Canadian crudes as they figure out their transportation issues. They'll actually also be a problem for some of the Middle East grades if the investment comes through as we're expecting and Middle East production rises come through as we're expecting. We do think there could be some troubles, especially for Iraq, in getting the crudes out of the country, just in terms of pipeline capacity and the FPSO, the floating platform loading capacities. They have expanded them, it is better, but there's a world in which they they produce more than they can very easily export. So some of those diffs widen a little bit, but we are generally stable in terms of our differential outlook. And again, that's because you're never really going to reach parity just due to the amount of medium sour and heavier crudes that are available out there. And by the way, feel free to stop with questions if anyone has any. So that's where we're looking at the market. We're generally constructive pricing, though not as constructive as some. Certainly, I know there are banks putting out $80 a barrel forecasts. As someone who came from some of those banks, I don't believe the underpinnings of them. I think they're being a little too reactive to current sentiment. We're seeing a lot of, what's happening today will happen forever. And as John said, that's not the case. You really do have to take a longer term, big picture view. We do think OPEC has more work to do. We hope markets generally come to that consensus by June as well, because if OPEC comes out in June and says we're extending the deal and keeping it firmly in place through first part of 2019, and markets turn around and say, but we're balanced, why are you bothering? They'll be undervaluing the amount of effort that OPEC really is putting forth to help rebalance these markets. So what are some of the upside price risks? I thought I'd lead with the good news first, although there are quite as many upside risks as there are downside risks. First one, geopolitics, one of my passion projects, certainly. The big thing is when the price downturn happened, shortly thereafter, geopolitical events were occurring that would have had my phone ringing off the hook. The sudden ascension of Crown Prince Mohammed bin Salman, tensions on the Korea Peninsula, civil unrest in Libya and Nigeria, all of these things I used to be up all night answering client questions about. Prices fell, they happened. Nobody really had questions because the thinking was, well, if Libya goes down again, we've got plenty of crude elsewhere. We're starting to get that interest again. We're starting to see it be a lot more important to clients, both in their short-term planning and their long-term planning. And that's an important thing to keep in mind. If you're going to go in and build several $1 million worth of infrastructure in a country, you should have a long-term geopolitical outlook on where they're trending. This is especially important for some of the Eastern European developments to know what they're trending towards in terms of market freedoms. No, Iran is on there. We actually, the Iran fear is not as big, I think, as some people think in terms, that's one of the geopolitical risks I think has been a little overblown. I'll get to what I think the actual impact on the JCPOA dissolving could be. These are more things that, they're more violent. More violent risks really is what the map was showing. And after a while you run out of room for the little red circles in the Middle East. We're also seeing this reflected in price volatility. The actual volatility index has been much more active this year than it was in 2017. So clearly interest in these things, and clearly overall pricing sentiment is starting to pick up. Another upside, potential OPEC supply disruptions. So you can see Iran here. Even if the JCPOA is completely dissolved on May 12th, which legislatively can't happen, it actually takes several steps after Trump refuses to certify the deal. There's a decertification process. He then has to go back and get legislative approval for certain sanctions. He then has to work with the State Department to monitor import levels from the main people who'd be impacted, identify which entities would be sanctioned. The whole thing is 6 months easy, probably more like 9 to 12, given the speed at which Washington moves lately. Even if Trump takes a view opposite to that, can Senate overrule him, or once he takes a decision? No, the Senate can't overrule him. He can do it via executive order. They could theoretically put up roadblocks to slow the executive order. I think there's a review process for it as well. And then keep in mind, he's only guaranteed to be through 4 years, so the next president could always come in and do the reverse of what he's doing. Doesn't look great for the stability of our treaties that we sign. But even if he does all of this, he goes through fairly smoothly, gets these volumes offline. This time around, it's really only likely to impact about 500,000 barrels a day in the short term. Couple of reasons for that. For one, the European Union and the European countries are not buying into it needing to be dissolved. There's a very high chance that even if he dissolves the JCPOA as it stands, they will continue on without him, and they'll refuse to reimpose the shipping insurance sanctions. And if you recall, when this first went down, it was the shipping insurance that really cut into the imports, because you had countries, Japan, India among them, that wanted to continue importing and couldn't get the shipping coverage, because that's really where you risk a lot of money as a refiner. And so we don't see those sanctions coming back nearly as quickly as he thinks they're going to. Additionally, there's a very strong chance Russia, China, perhaps even India just say, we're going to keep buying the crude. We're going to find a workaround with middlemen. We're going to find a workaround with non-sanctioned entities. It's unlikely that the administration will put the rules back in such a way that there are no loopholes. And if you're an entity that doesn't really do a lot of U.S. business already, being sanctioned to not do U.S. business isn't that big of a problem. You can do business in Europe in this world, because Europe isn't putting the sanctions back in place. So if you're willing to trade in euros, you're good to go. So the Iran issue isn't going to be a panacea for prices, essentially. On top of that, other risks, Libya and Nigeria, there are perennial favorites. The problem with them is as prices rise, you have these marginalized groups that were the ones taking production off earlier. The higher they see prices and the less benefit they see in the community, the higher the likelihood they reinstate those militant actions. And so that's a big issue in the Niger Delta. You're literally in a balancing act of, can Nigeria afford to protect its infrastructure versus how much people think they're missing out on prices? So if prices spend too long above $70 a barrel or so, which seems to be the sweet spot for Nigeria can make its payments, and the smaller tribal groups don't think they're being left out, the longer prices are above that $70 a barrel mark, the higher the chance of a disruption. Similar story in Libya with the militias. The more valuable having control of those fields is, the more likely they are to not want to just get paid their salaries, but in fact control the field completely. So those are disruptions that could take about 1.4 million barrels a day offline. The chances of them all hitting at the same time, not very high. So they aren't built into our reference case. We actually have our reference case with the Iran, Libya, and Nigeria pretty much continuing as they are now. Downside price risks. I told you the upside, there's not a lot of it in the short term. Longer term, there is some in terms of demand growth surprising and an underinvestment in supply leading to a larger supply crunch than we're currently expecting. That is another long-term upside price risk. Downside price risks. U.S. supply could surprise to the upside. Now, I have shown this chart literally all around the globe at this point, and no one has come to consensus on whether they agree with it or not. We've been saying since about third quarter of last year, we expect U.S. unconventional to grow about 1 million barrels a day this year, 800,000 barrels a day next year. Then we generally have it growing moving forward. In the short term, at the end of last year, I went into offices and told people this, basically got laughed out of the room. There's no way the U.S. is growing 1 million barrels a day. They're not going to be able to handle the service costs. They're not going to be able to get the labor. The prices aren't going to support it. The IEA and the EIA are now forecasting around 1.3 million barrels a day of growth. So the world's turned around on that one pretty quickly. We stick around our 1 million barrel a day mark. We actually have a North America shale analyst who looks at this literally on a well-by-well basis and builds it up, taking into account the decline rates, the need to move into less optimal production zones, increases in service costs. We obviously don't hold those steady. We expect both natural inflation and costs rising due to renegotiating contracts and using these more expensive completion methods. They're putting more proppant in, they're doing longer laterals. That all costs more money. So he looks at that and continues to believe this is our view moving forward. It isn't enough to solve global supply, though. So I believe we had a question a little earlier around the decline rates. They are very important. I will say, like John said, This year alone, we've gotten a lot more interest in some questions around the scoop, the stack, the mid-continent, Appalachia, some of the plays that fell out of favor when price was of importance. Producers are clearly feeling a little more confident now, a little more willing to spend the money to test out those sweet spots. So they are going to increase exploration and production in those areas, which is a reason U.S. supply could again go to the upside. Also keep in mind, they hedged a lot at the start of this year. Not only 2018 volumes, but we saw much more hedging than we normally see in 2019 volumes. So regardless of what happens to prices tomorrow, a significant portion of U.S. unconventional for the next 8 quarters is locked in. It's already planned to be sold at profitable prices. So by reducing that risk exposure for themselves, they've raised risk exposure for the rest of the markets. The OPEC deal could dissolve. So here you'll see year-on-year OPEC production by month. The red bar is the annual average. Essentially, if the OPEC deal were to dissolve in June, if they can't reach a consensus on continuing it, you could quickly add about 1 million barrels a day back to markets, which is roughly the gap between the 2 red bars. We don't see the full 1.5 million coming back just due to some of the actual technical limitations some of the producers are facing due to shutting in these fields, needing to reopen them. But if the deal dissolves, I mean, that's 1 million barrels a day easy back in markets. We don't see that happening in our reference case. It is worked into several of our bear cases. There's a world in which they can't build consensus on the need for continued cuts because of what U.S. supply is doing and because we have these elevated prices. So there is a world in which they come together and say, we're not subsidizing these producers who haven't cut, we're just going to dissolve the deal and prices will react accordingly, and then we can come back and put it in place if need be. I would say one thing to point out, we don't see the deal dissolving due to political disputes. I get that question a lot recently. You know, is the issues between Saudi and Iran, is that going to play into it? It's really not going to. We've seen OPEC successfully manage production while actively at war with each other. I'm talking tanks on the ground in another person's country, and still they came to these meetings and said, yeah, we're going to continue to stick to our production agreement, and they did an okay job at it. So these proxy conflicts and these debates aren't really going to be enough to derail the deal. It's going to come down to pricing and what U.S. supply is doing. Demand growth could disappoint. So this is, year-on-year total product demand growth by region. Obviously, we continue to see in the short term and longer term, Asia is one of the larger demand growth centers. Longer term, we also see Africa and Latin America picking up, most importantly. In the short term, you see Latin America gets better. It doesn't start growing, but it stops falling. That's because we're expecting current fiscal reforms that have been put into place to actually be carried out. There's a chance, given the number of elections this year, that some of that gets derailed. I think the U.S. has provided a pretty good example of what can happen when a very publicly influential leader gets put into power and quickly starts issuing executive orders. So there is a chance that some of the reforms that we see driving improvements in Brazil and Argentina and others could be reversed. So demand growth could disappoint. Longer term, if electrification happens quicker than we are expecting, if the grid issue is solved and the battery issue is solved, and we see a much larger uptick sooner than we think in electrification, that would be a serious impediment to demand. There would still be solid petrochemical growth. The long-term petrochemical view doesn't have as many risks, but on the transport side, it would be electrification and to a lesser extent, autonomous vehicles. So wrap it up and then we'll dive into questions. Markets are better but not yet balanced. Don't get me wrong, I am not a bear in any sense of the word. We are constructive short and long term. It's just we're not quite as constructive as sentiment is at the moment. Supply is really the determining factor in the short term. Longer term, it's a little more of a demand story, and the pace of demand changes, which we'll hear about this afternoon. Geopolitics is really going to grab headlines and drive prices. I don't think this is healthy market behavior. The issues around the Syria retaliatory bombing, when you actually looked at that, they drove prices $3, $4, but the actual volumes at risk were really minimal. So we are going to kind of have to readjust to risk premiums as an industry and not allow geopolitics to drive prices too much except where it's warranted. And again, despite the recent bull run, risks remain skewed to the downside. We do expect a small correction upcoming, probably as soon as this quarter, and then overall constructive pricing. So, any questions? You can disagree with me, by the way. Feel free, because I love it when people give me another way to think about it. I know I was over coffee talking about our long-term belief that the 2-degree agreement, we don't see it actually effectively coming into play. You can sign all the paperwork you want, but until I've got solar panels in my backyard, I'm using natural gas on my stove. So that is one point of contention we run into sometimes.
So you do a Brent Dubai differential as well?
Yeah, I think we also have a Brent Dubai differential. Apologies, I didn't show it, but it's following roughly the same pattern in terms of there's no major changes, and there really aren't any of the midstream constraints there either. So it does stay a little bit tighter than, say, some of the WTI, WCS, or some of the Brent and other lighter crudes.
Yeah, on our price forecasting, we got.
It's a lot. I didn't think you wanted to see 68 lines, but we have all of them available online. And we rerun these numbers every quarter, though I laser focus, and I probably bother my team just a little bit because I don't like us to make large changes quarter to quarter. And then we do the long term every year. We rerun those. Yeah?
You're saying that it's not at balance.
It's not.
Then when it is going to be balanced?
Start of 2019.
2019.
Yeah, which conveniently is when OPEC's deal is supposed to last until. So if OPEC sticks to its guns and carries on the deal through the start of 2019, even accounting for increased slippage in compliance through the latter half of the year, so even building in a little bit of cheating there, we view that markets will be balanced against a normalized historical average by about first quarter 2019. And that's on both crude and products. I think products might come in like 2 months earlier in the fourth quarter of this year if things go well, but 1Q 2019.
So what is your take on the media report that Saudi is now thinking of $100 mark?
Of a what?
Saudi is aiming at $100 mark. What is your take on that?
I think once you get one cookie, you sometimes want a second cookie. A couple of years ago, they were aiming for the $65 mark, and then the 70, and then 75, and now they're aiming for 80. I don't think it's as driven by the IPO as people believe, though. Partially because I'm losing faith every day that the IPO will happen in a really believable way. I think it's more driven by they need these revenues to undertake some of their other economic ambitions and some of their proxy wars. But yeah, I think it's, and I worry about this leading into June, a case of getting a little greedy. And if you see it in reach, why not try and grab it?
And you are saying that by January next year it is going to be balanced. When logically, OPEC should take back their cuts. But suppose they want to delay it for 6 months, then probably it will go going for a whole run to 100 or so.
Are you saying if they extend the cuts through the first half of 2019, what'll it do? I think if they actually do that, especially if they make that announcement in June, you're going to see higher U.S. supply than we currently have built in. I think the U.S. producers are really going to take advantage of that window if they get it on paper. But yeah, there would theoretically, and this is where it comes down to the perception. If we go into it in June and people are like, well, we're balanced now, why are you continuing to cut? And or we're balanced now, keep cutting, it's making us a ton of money. You could arguably see your scenario played out this June. Hopefully markets will come to a bit better of a consensus in terms of where stock levels actually are. And this is going to be dependent on messaging from the Secretariat. They have started this messaging already. They're really putting the story out there of you have to look at a normalized 5-year average. If people don't believe it, though, then come June, markets are balanced, you guys are still cutting, we're going to see a substantial spike in prices, which is not sustainable because it brings in that U.S. supply again. Sure.
If a small supply restriction of 1 to 2% can lead to a price rise of $40 to $80, does it have any quantifiable impact on the demand in the same period? Or the demand normally you see overall remains the same?
No, it would have an impact on demand. And stay tuned for this afternoon. We get to talk about my other favorite item, non-OECD elasticity of demand in the face of rising prices. So if you did see this kind of supply restriction and that level of increase in prices, we would expect demand, especially in a lot of the non-OECD markets, which removed subsidies and or added consumption taxes lately. We'd expect a much larger contraction in demand there as consumers suddenly became very market oriented. And we've actually seen, I don't want to give away my punchline later, we've actually already seen evidence of this market oriented behavior coming out of Saudi Arabian consumers. In terms of their gasoline prices around price rises. So clearly it is an issue. Right now, given our reference case, we think it only impacts sort of the margins. Max, it could take away, in a worst case scenario, 150 to 300,000 barrels a day of demand growth. And that's part of how you get from our 1.5 to our 1.1. A larger price spike, though, would have a worse effect. And I think there was,
At the risk of being seen as a green Martian in the room, can I still ask what's your outlook on biofuels and its role in demand destruction?
Sure. So I am not our biofuels analyst. He unfortunately couldn't join us today, but I can give you my biased view as a crude oil analyst that I don't think it's going to matter at all. No, it is important. That actually, biofuels, I think, pose a greater risk than electrification right now in terms of the adoption of them, because that's happening now. The technology is there, it's fairly perfected. Cars can run on these biofuel blends, so it is the larger risk to demand destruction. And it's probably also a larger risk in some of the non-OECD countries, which are more willing psychologically to adopt these fuels and to live under these restrictions. Like someone was saying earlier, you can't view all gasoline markets the same, because you actually run into psychological market development issues where in the US they tried to introduce an E15 biofuel blend and people were up in arms. Car companies fought back against it, saying, the cars won't run as well and all of this. Whereas if you do something like that, and there are higher biofuel blends in a lot of the non-OECD countries, people are fine. Fuel is fuel as long as the car gets you from point A to point B. So it is a risk, especially in our larger developing countries, in the Asian markets and the Latin American ones. So you are not the green Martian in the room. I secretly agree with you, but if my boss asks, we're going to need crude oil forever. Anything else? Great. Maybe I got us a little back on schedule. If you think of anything, I'm here this afternoon, and I'm also around all day. So I'll pass it back to John.
Thanks, Ashley. And George, what's next? So George Pops, George is going to talk about global natural gas. Thank you. I'm now done. So.
We would still appreciate if you show the graph between Dubai and Brent. Anytime whenever it's possible.
Sure, I can
number
certainly
4,
back in the materials afterwards, too.
You can pull it up.